Hello, and welcome to Advisory Explained. I'm your host, Kosie. Join me in this series, this podcast where we discuss the complex world of advisory. We dive deep into very specific topics in the world of mergers and acquisitions, due diligence, tax, fiduciary services, and so much more, where we take complex topics and we break them down into smaller, bite-sized, palatable portions for you to understand and to understand where we can assist you. Welcome back to another episode of Advisory Explained, a podcast where we take complex topics and we break them down into easy, digestible points. I'm grateful to have one of my close friends here today, Bobby Wessels from AJM, and we've got an exciting topic to discuss, maybe a little bit controversial in terms of just thoughts, not necessarily conclusions, but just thoughts. Bobby, thank you so much for joining us today.
Thanks a lot, Kosie. It's lovely to be here. I think this is our fifth one together, so we've gone for something pushing the boundaries a bit, but looking forward to it.
Absolutely. Hoping to get a lot of comments on today's discussion. Bobby, we're going to discuss the deductibility of expenses. Now, before everyone in the comments start reaching out and screaming and saying, listen, it's easy, just deduct it and then wait. We've got a few questions on certain expenses, if they are really deductible or not. Bobby, let's start at the beginning. The general deduction formula. Let's start there. If you can take us off from that point.
Yeah, I think that's the starting point when you're looking at deducting most expenses. You know, you have a lot of specific, call it deductions in the Income Tax Act, but the general one is the one that most people are quite familiar with, and it's really got a few legs to it and a few arms as part of the test that one needs to go through. So the first is there needs to be expenditure that's actually incurred. That expenditure must be in the production of income and part of your trade, and then ultimately the expenditure must not be of a capital nature. I think you and I are going to focus on that in the production of income part and the capital nature part and see where that test leads us.
Absolutely, and you've got the nail right there. But let's quickly break it up. For all of this, the case law becomes very crucial. What to think about, what to listen to, how to interpret. So both for in the production of income and for as a capital in nature. Can you quickly describe the two of us with the prevalent case law to each?
Yeah, so it's interesting, Kosie, because you'll see that in even the most recent cases. I think that one of the most recent ones that we've got in the South African tax environment is Shishin mining. And even in that case, there's a significant amount of repeating principles in cases. And then it becomes a question of applying those principles to the specific set of facts. So these principles have been distilled. They go back to the early 1920s almost, you know, for some of these cases. But really, if you're looking in the two camps that we're going to speak in, capital in nature and in the production of income side, there's a handful of ones that really stand out. In the production of income, I think the locus classicus is PE tramways. And short judgment, but one that has stood the test of time, and ever since then, it's one that we still refer to today. Basically, what PE tramway says is the first thing you must look at is what the purpose of the expenditure was, or the purpose of the act leading to the expenditure. And then secondly, you must look at whether it is so closely connected to the business operations or the business income of the company or the entity that it can be said to be part of that of that business effectively. That's what you have in the production of income side. On the other end, you know, in the capital nature side, there's a plethora of cases. But one of my favorite ones is George Forest Timbers, and I'm going to mention it specifically here for an interesting reason because we're going to touch on it a little bit later. And the one thing about George Forest Timbers is there's a line in the judgment that says there's a difference between creating capital and working capital. And I always thought, you know, you study these at university and then you learn these sort of one-liners that you've got to remember. I thought, that makes quite a lot of sense to me. That's quite obvious. But when you look at real-world examples and you start grappling with these issues in the real world, they're not so obvious all the time, to me at least, that is.
Absolutely. So, Bobby, once again, let's keep it basic before we get into the more complex things. Practically, correct me if I'm wrong, but in the production of income, so cash outflow for something that is in the production of income, I can deduct in that year of assessment for income that I made. So cash inflow that is taxable income at the end of the day. Cash outflow, once again, for capital in nature assets is part of base cost. So I do not get the immediate deduction. There is probably a wear and tear allowance, possibly not. Other than that, my base cost is built up over all those specific expenses and can then be deducted from the proceeds that I gain once that asset is disposed of in the future.
Yeah, very, very nicely said, Kosie. I think the big thing to remember on the introduction of income side, the small nuance, is that it doesn't necessarily always need to lead to income as such. It must have the ability to lead to income. So let's say I put up a stall and I'm going to sell a bunch of hot dogs on the Sea Point Promenade, and I incur a whole range of costs to sell a hot dog. And I don't sell a single hot dog that day. Doesn't mean that those expenses aren't deductible for me. They have the ability to generate income for me. They just didn't generate income immediately. Maybe they will sometimes in the future, at some point in the future, maybe they won't. But that's not the test on the in production of income side. It's just, does it have the ability to create income for me in the short, medium, long run?
Absolutely. So let's start throwing a few spanners in the works at the moment. So the first question is, let's chat about BE, okay? Triple B, double E at the end of the day. Are my BE expenditure that I incur actually tax deductible?
Yeah, it's an interesting question. The big thing is to understand why you have certain ranges of BE expenditure. Now, I'm not an expert on the actual BE scorecard, but really at the end of the day, what it's about is that if you incur certain levels of expenditure or you sort of incur certain costs, you get certain points which help your BEE scorecard, and having a stronger BEE scorecard ultimately leads to you being able to win certain jobs in different markets. Think if you're working with government or if you're working with entities that are working with government, because their suppliers' scorecard also matter to them in some respects. So the idea behind it, and you see it in a number of ways that it comes across, is that I'm going to incur certain expenditure to strengthen my scorecard with the ultimate aim of that being in the product, or hopefully that I can earn some income from that. Now, if you apply the in the production of income test to that specific level of expenditure, yes, the one thing we must say before we delve into any of this any further, it's very fact specific. And the idea behind today's conversation is not to say that certain things are always deductible, always non-deductible. It's to say that you should think about these more carefully, because it actually matters, and people oftentimes take a very narrow-minded view to it. So I'm not saying that, all BEE points in all scenarios always is in the production of income, but I think in a fair parts of them, it certainly is, and it will depend on what your specific set of facts are. The challenge on the BEE scorecard side, I think, usually lies in the capital in nature element. And really what that capital in nature element looks at is it something that is the cost leading to some form of a creation of an asset, or is it cost incurred towards the creation of the capital structure of my business, or is it a cost that is incurred towards the income side of my business, the operational element of my business? And I think there are instances in the BE case where you really need to think carefully about the capital in nature side of those expenditures, and whether they might be capital in nature. Sometimes certain BE costs are once off. Now, we have this loose test in our law that a once and for all expense is more capital in nature. I think the big thing to remember is that that's not conclusive. It is only but one of the considerations that one has when you look at the capital in nature side. So simply because there are certain BE expenditure that is once off doesn't necessarily always mean that it is capital in nature. But I find in practice that that's the place where the largest challenge comes in when you're looking at BE points.
Absolutely. And I think in my world, and also not a BE specialist at all, I do work somewhat a little bit with it. I think a large portion of it is we need to also understand there's multiple facets to expenditure in the BE world. So you've got professional fees in guidance and consulting, etc., on your scorecard. Then there's working and expenditure in your scorecard, training, ownership, etc. So there's a bunch of these different areas that we need to consider. A question that I want to ask you is, and I'm going to make it in a very general, and once again, there's no right or wrong answer, it's just a discussion point. But if we think about a tree that has fruit, right? My BE scorecard allows me to sell the fruit. Or does it allow me to maybe have the tree to be able to go to market? Maybe if the question is it required for me for a specific market, or is it just a add-on benefit? And the expenditure in that world.
So the fruit and the tree analogy is one that's obviously littered in our law when you're trying to look at capital and nature expenditure. And it sounds very easy in principle. You know, I've got a tree, an apple comes from it, and the tree, the cost of planting that tree is capital, but everything that goes around curating that apple, you know, that's maybe more towards the income side of things and therefore not capital in nature. As you've rightly pointed out, it becomes quite tricky when you look at the real world. And so I think there are scenarios in which your BE scorecard is your tree in your analogy, and there are times where it's your apple or your fruit in the analogy. And I think that's the important part of the podcast. So I'm going to say it again. Hopefully people have listened up until this point already, is that this is not to say that this isn't a blanket rule for every single piece of expenditure that we're going to discuss. The question is just, are people thinking about these further than just, I can run this thing through my income statement and deduct it? And are there some nuances that need to be borne in mind so that you don't fall on the wrong side of the law? And I think the big thing is to take each set of facts and look at them each specifically, and not to say that, oh, because it was in this specific context, these points aren't deductible, that they're not deductible, and then vice versa on the deduction side. It's a facts-based question. Can it be the tree? I think it can. There are definitely instances in which I think, unfortunately, your BE points or your costs incurred for your BE points is your tree. But I think in the majority of cases, at least that I've looked at, you'll more often than not be able to argue that it's the fruit and therefore deductible.
And I think that is absolutely a crucial point for everyone that's tuning in today. Is it's fact specific. So please, if you have any questions, reach out to myself, reach out to Bobby, and let's test your facts, and we'll be able to give you a better guidance in terms of the actual circumstance where you are in, as well as the intention that you are trying to get to at the end of the day. And that's what this discussion is about, is getting people to open up about the conversation and asking the question, am I doing the right thing or am I just assuming? Bobby, the next one is, it's quite funny, and I'll explain after you've given a few examples, but damages and fraud. So if in Afrikaans we've got a saying, ek's gevat vir feile, I got scammed, something happened, I lost money. Is that tax deductible?
So short answer, possibly. Let's look at the longer answer. I think people are more interested in that necessarily. I think you've got to distinguish again between different scenarios. So the one that's come across my desk quite often in the last 2 or 3 years, at least as the idea of cybercrime has significantly increased, is what happens is people send across banking details. Somewhere in that process that I still don't quite understand how it happens, these banking details gets intercepted, they get changed, they get passed on. Someone makes a payment into the wrong bank account. You see this threat is very prevalent in financial institutions that are holding funds on behalf of other people. And so what you often find is that there are some procedures internally that are put in place. Like, for example, you cannot just pay you can't just pay the amount based on a bank details that you've been sent. You've got to confirm that and make a call and confirm it. So people are trying to put in place certain factors to prevent, or at least points to prevent this from taking place. I think in those cases, we've got these two instances specifically looking at fraud. And the thing that you'll see that I've underlyingly mentioned here now is there's potentially also an element of negligence. And why is there element of negligence? Well, what happens if we do have an internal process that says I should make a call before I make this payment, and then I don't make the call, and I make the payment, then I make it into the wrong bank account? What do I do then? Now, we've got these two cases in our law that has been written about relatively extensively and that seem to suggest that you'll never be able to deduct an expense in the case of negligence, and it's in Joffy and then in PE tramways, which was already discussed. I think what's overlooked about these two cases is, firstly, PE tramways, is the remarks are just made obiter. Now, for our non-legal viewers, that just means that it's a side note that the court makes, a side thought, but not one that's necessarily it's not binding. In Joffy, Joffy is often taken for the authority to say, well, you cannot deduct expenses there where there's been negligence. Well, it's not. If you read the judgment carefully, you'll see that that's not what the court says. What the court says is that in that specific case, the taxpayer couldn't prove that the expenditure was so closely connected to its business operations, coming back to in the production of income test that we spoke about earlier, so to say that expenditure is in the production of income. Meaning the court doesn't make a blanket ruling on whether negligence, and in the case of fraud, is deductible or not. It just says, again, and I think this points to what we've repeated a few times now, the fact-specific nature of each transaction, each set of facts. In my view, there is enough, I think, factual circumstances that I've seen in certain cases to say that these amounts are actually deductible. Notwithstanding Joffy, notwithstanding PE tramways, because if you look at the specific set of facts and what entails and what happened there, specifically where you have people that they have trust accounts, and it's an inherent part of their business is paying funds across from one client on behalf of one client to another client. And with I think the world that we're in now, where that type of level of fraud and cybercrime is so prevalent, it links you back to a question you asked right at the beginning, which is to say, are these cases still relevant? I would say absolutely they're relevant, but they need to be adjusted, and we need to consider them in light of the situations and the facts that we find ourselves, the world that we find ourselves in, such as, for example, cybercrime scenario, which we could never have foreseen in the 1930s, 40s, when majority of these judgments are delivered.
Absolutely. And just on that, a side note, Bobby spoke about negligence and making sure you have the right systems and processes in place. So if you have any questions about getting the right systems in place for making payments and these type of processes in your business, please reach out. One of our previous episodes, we had one of our partners, Drian Bielefeld, which is one of our Xero partners on the podcast. And one of the beautiful things about Xero is that it has this attachment or add-on which helps you with bank confirmations before payments. That's something that we use, and I must say it's quite efficient to make sure we follow the process, and you can't bypass that. So you physically can't forget to do it. That's part of the process, part of clicking the button, and that says make payment. So please reach out. But once again, I want to iterate one of Bobby's main points is everything is fact specific at the end of the day. And once again, if you have a question, reach out and we'll assist you. Bobby, a few high-level other examples. My family, very special, love them to bits, but have the ability to buy random things online, which are not necessarily real websites. Expenses like that, if that happens to you in your business world. Yes, no, once again, fact specific. Is that something we can look at as possibly tax deduction? Or is it once again looking at what did I buy? And also the negligence point behind it. Does it look weird, etc.?
Yes, I think, are they deductible? I think they're definitely, again, there are cases where it is deductible. What's important there, I think the one that you need to think about carefully is what it is that you're buying, and so therefore the capital in nature element is probably more prevalent. If I'm buying a bunch of Bitcoin to invest in for a long term and it's in a scheme that ends up at some other point going belly up and there's nothing left for me, then I possibly have a capital loss as opposed to this Section 11A deduction that I can claim. I've got an asset, I paid 100 Rand for it, it's now worth nothing. I've got a capital loss of 100 Rand. Alternatively, I want to buy, I am in the fashion industry, I want to buy a bunch of clothes to test. I buy off some unreputable website and these never arrive at my doorstep. Well, in that case, I think, that the expense had the ability to lead to income, at least in my view. And the fact that it didn't is not necessarily so relevant in the context of the production of income test. I don't see how if those expenses aren't capital in nature, they would have formed part of your everyday inventory. Well, I think there's a strong argument to be made that yes, they are deductible.
Fantastic. And I think now we're going to get to sort of the controversial question for today. Thinking of an interesting topic, something you've got questions about, leave it in the comments and maybe we'll do an episode just for you. Salaries for staff, but not just any staff. Salaries for staff working on capital assets specifically. Are those salaries deductible? And there's a few examples that we can throw around, but let's start with, once again, fact specific, and that's very important. But I would love to hear your opinion.
Yeah, it's perhaps a controversial one because people often just think salaries. It's deductible. It goes on my income statement. It's one of the best forms of a deductible expense that you could possibly give.
Most certainly deductible.
Exactly.
It must be.
Exactly. It must be. Exactly. I've just, over the few years in practice, come across scenarios where I thought, I'm not so sure that it must be deductible all the time. And I'm not saying that there isn't another form of a tax advantage to it. I'm just saying I don't think it's necessarily tax deductible in terms of Section 11A. And the reason I say that is I think there are some certain salary expenses that are actually contribute to the tree, if we go back to your previous analogy, not so much to the apple that one might think about. And there's nothing to say in the Income Tax Act that salary expenses are always deductible. That's not the test. We have to put the expense through the tests in the Income Tax Act, and the one that we're obviously focusing on here today is Section 11A. Now, it may be deductible on another basis because let's say I'm right that it gets capitalized to the asset. That asset may also get a deduction in another form, and so therefore we could end up in the same scenario. But it's not a foregone conclusion to me that all salaries are always deductible.
Absolutely. And I think if we start looking at a few examples, I think people will realize, once again, it's fact specific. And you need to ask the question, am I busy constructing a tree or am I busy selling the apples? And what are we busy with at the end of the day? An example that I could put on the table is programming, software developers. They are physically developing, especially if it's probably in-house software, that those salaries could possibly, not necessarily, but could possibly be capital in nature rather than expense in the production of income. Another option or probability of a question that could be is in the fiber world. And you can maybe elaborate a little bit on that?
Yeah, so if you look at the development side in that software element, I think you can split it typically into two parts. You usually have a development team, someone that goes about developing the IP or developing the software, and then you've got a maintenance team, a team that looks after that IP every day, because as this world goes, if you don't keep maintaining your IP, it ends up becoming worthless. And if you don't keep inventing new IP, it also ends up becoming worthless. So on the maintenance side, I think, so let's just go to the 11A formula where we're going to get stuck there. I don't think we're going to get stuck in the production of income. I think we're going to get stuck potentially on the capital in nature side. Because as you've mentioned, some of these costs I think is going towards the tree, not towards the apple. Now on the maintenance side, I think that is by and large going to be deductible for you and not of capital nature. I think that to my mind goes towards the apple. On the development side, I think there is a solid argument to be made in some cases that I've seen and that I have advised on to say that unfortunately I don't think these costs are deductible in terms of Section 11A. I think there are costs that are attributable to your capital asset and that really as a result are capital in nature. They're not part of the operational element of your business. They're contributing to the capital structure of your business. So it depends on your model and what it is that you sell. And I don't want to keep laboring the point of fact specific. I just want to sort of put it out there. But Yeah, I think in as much as people might think that it's always deductible, I'm not convinced.
Absolutely. And I must say, we do have a few kamikaze clients out there or financials that I've seen where people do deduct it and then put it on their balance sheet. So they they claim the base cost portion of it and then the expense. So there is some interesting creative accounting outside that is definitely not right. But once again, we want to encourage everyone to ask the question. Another example could be if I am in the world of property development, but I don't sell the property, I develop for myself. I've got my own team that builds and construct the physical building, and then I rent it out as an investment property. Question is, those expenses, the staff specifically, once again, is that capitalized or is that an expense?
Yeah, for the reasons that I said in relation to the software, I think that there's a very strong likelihood that they are capital in nature and not deductible for you as part of your normal income generating activities. I think another one that you touched on earlier is, and you see this very often in the fiber industry, where there are various, underneath or next to the road, there are these holes that need to be dug so that you can lay the fiber. And potentially, depending on how those contracts are worded and who takes responsibility for which portions of that work, I think there are potentially certain parts of the work that could be said to be capital in nature, and that I think sometimes just because people think that salaries are always deductible, they just get slipped through in some form of a way.
Absolutely. And I must say, for a large extent, I do hope SARS doesn't necessarily listen to today, but it is a question that we need to ask, and we need to heed people to ask the right questions at the end of the day. I think if we move away from the very specific property assets heavy, let's say top side of your balance sheet assets to current assets, what about inventory? So I've got a manufacturing business and we manufacture braais, for instance. Those salaries directly linked to cost of sales. So I've got a bunch of wage workers that they physically make the braais that we sell. Accounting wise, IS2, we allocate those expenses to cost of sales. What about those expenses? Deductible, yes, because it's in the production of income, but also it flows into an asset that sits on the balance sheet.
So interesting. It's where our two worlds, I think, sort of meet up a bit, and you've seen this happen more and more, and the suggestions of late in terms of Section 8E seem to suggest that that's where the world, at least South African National Treasury, is thinking, and that is to say that should we not align accounting standards with tax treatment? And, we've got all these different accounting standards that tell us how certain elements of our business should be accounted for, and sometimes that's not the case in tax. We've got different ways of accounting for it. And so one of the ways that we do see in the Income Tax Act is to say that, yes, those expenses are deductible. Those inventory expenses that you've mentioned now, absolutely, they relate to my Apple. But that's not the problem. Where the problem comes in, or where the sort of more clever thinking comes in, is that if those expenses are allocated towards my cost of sales in terms of IS2, means that for tax purposes at the end of the year, the portion of my closing stock that relate to those IS2 related costs, if I can call it that, that must be counted back, which means that my staff salaries that form part of, call it my IS2 costs for purposes of this discussion, they're all of a sudden deductible, but they get added back at the end of the year. Doesn't mean they're not deductible, doesn't mean they'll never be deductible. It just means that as long as they are allocated to a portion of stock which form part of my closing stock, they will only become deductible once I've realized that closing stock. Not because they're not deductible in terms of Section 11A, but because Section 22 says that if my costs are allocated to IS2, I need to count them back at the end of the year.
Absolutely, and I think that's a very crucial thing, and it comes back to, is your accounting done right? Because if your accounting done right and your ABC costing or whatever costing mechanism you use in your business is performed correctly and cost allocation is done correctly, then I don't want to say by default, but if your accountant is doing their job correctly, then yes, this is most probably one of the areas that you are doing correctly without necessarily thinking about the complexity behind it in terms of is the IS2 expenses that flow through cost of sales actually added back for Section 22, which I think most people actually do get right. But once again, you need to ask the question, is this done correctly? Once again, I want to refer back to a previous episode that we did with Dreon. If you need assistance with any of your cost accounting, please reach out and we'll definitely be able to assist you with that. As I've said multiple times on this podcast, I'm a chartered accountant. I'm not necessarily a content creator. So your feedback means a lot. Probably a last thing, and it's not linked necessarily to this, but we started to open up the conversation, and we'll definitely do a separate session on this, is what big risk, well, in my world, I think there's a big risk in linking accounting and tax too close to each other. And not because, obviously, it will make life so much easier in most cases for a lot of accountants which studied accounting and now have to apply tax law. But then all of a sudden you are taking the position to say the one is right and the other one is wrong, and the one will always be right.
I'm glad that you're finding more topics for us to talk about because I'm running out of some. But it's a very interesting debate, Kosie, and I think there's a large part of the legal fraternity that thinks that having your accounting standards flow into your tax law in the way that we've seen and the way that's been suggested is actually an unconstitutional sort of exercise or move, call it that. And the reason that is because all of a sudden your law is now changing based off law that someone else is making. The National Treasury has zero insight into what the accounting standards will do year on year and how they will change. But it means that if we link our law to accounting standards, we are effectively giving away our judicial power to some other third-party accounting that set out our accounting standards. That's not even necessarily South African based. And so the big question around doing that is whether you're not just actually delegating in some form of a way your constitutional powers of making law to, let's be honest, in the context of tax law, a random third party. Not
Absolutely.
saying that's what our accounting fraternity is. I'm just saying in the context of our tax law that is what they could perceive to be, and that's the biggest challenge that you have with doing so.
I completely agree with you. I think it becomes almost abdicating your responsibility to make sure that you've got relevant, applicable, and correct tax law in a country, and giving it away, especially if you link it to IFRS, then, well, that's an international financial regulatory standard, so and reporting standards. So the question is that right? Now, coming from being a chartered accountant myself and knowing the complexities in IFRS, and well, I grew up with it, so to a large extent, yes, I do think the IFRS treatment on a lot of stuff is, in my world, correct, but that's how I grew up with it, rather than looking at it from a tax perspective.
I think it also leads to this weird world of intersection between accountants and lawyers, where fundamentally, I think tax is law. So fundamentally, tax is governed by lawyers, but it's got this significant financial and accounting element to it. Now, all of a sudden, if you're linking what happens in your tax law to your accounting standards, then your accountants and your lawyers are going to start fighting about accounting standards, not about the law. And I think that, there's a lot to be said for interpretation in the IFRS standards. That just because there's some form of an accounting standard that is perceivedly easy to determine doesn't mean that it is the case. You would know in your world, you fight about these things all the time. It's why you have things such as IFRS specialists. It's because there's different interpretations that can be taken on different points. Now, can I say, it will make for a very interesting case if you let lawyers loose in the IFRS standards, because I think it's going to challenge a lot of the interpretational thoughts that are consistent in IFRS. But and it's this is not a legal point. This is not a point that you make as that's specifically novel from a legal perspective. I'm just saying practically, if we do move towards a system like that, there's a really interesting space where lawyers and accountants are going to need to interact on that. I'm not so sure is beneficial.
Absolutely, and I think just as a last point, one of the most controversial ones would be if we start throwing in the valuation methodologies into this in terms of is deferred tax a tax? Now, deferred tax is an accounting treatment. It's not a tax treatment, but it's based on tax principles. And I had quite a large debate with quite a prominent senior counsel on a legal case, specifically because of that, because we argued that point A is something, and he argued point B, and you completely missed it, in my opinion. But in any case, Bobby, thank you so much. Really appreciate it. And that's a wrap. So thank you very much for everyone tuning in today, listening to our hopeful, fruitful discussion about, well, is certain expenses deductible? Once again, everything is fact specific, so please reach out if you have any questions. We are more than welcome and able to assist you. Thank you very much. We at Bagatelle Greenwoods strive to be trusted advisors. If that is who you are looking for, please reach out to us via our website, bagatellegreenwoods.co.za.